In this video, traders, I want to look at different types of gap. Stick around. Hey guys, warm welcome to you. Thank you so much for joining me. All right, so different types of gap. So we often think of gap as just, there's a generic gap, right? Oh, it's a gap market. And maybe we categorize it as a gap up or gap down. But there's so many more different types of gaps. And the good thing about categorizing the gap type is that you can then come up with a playbook for the day. So the more granular you get with categorizing the type of gap and the response to the gap, the more you can say, okay, these are maybe the two or three scenarios that I'll look to trade at the open, or at the lunchtime kind of peak, or whatever it may be. So let's think of these different scenarios. Now, I know for you guys trading Forex, this is only going to apply at the weekends, but if we're trading a US index, for example, UX index, like the Dow, S&P, NASDAQ, we're looking at the gap from the regular trading hours. So I know that they trade all through the evening, and there's kind of only that short little break in futures after the close. But we're not looking at that from a gap perspective. We want to look at it from a regular trading hours perspective. So if you quantify that with using SPY, Qs, DIA as an ETF, that just helps you visualize the gap if you're trading that. Obviously, if you're trading stocks, you strip out the pre-market and post-market session. Okay, different gap types. So before we carry on with this, why is a gap important? A gap is important from my perspective and the way that I view it, in that it's a change and shift in the agreed value of that asset. So the price has gapped up. All of a sudden, for whatever reason, there's been a collective agreement, if you like, loosely put, that the value of that asset is slightly higher. And if we get a really big gap, and obviously the perception is that that value has changed significantly, and we see often catalysts causing gaps as well as normal kind of price movement. So a catalyst would be earnings on a stock, or maybe there's been some sort of interest rate announcement, some sort of global news hit the market in the evenings that's caused the gap up. But we often get just gaps just based on supply demand, right? Big strong market, closes at highs, then gaps up the next day because people are kind of urgently trying to buy things and are prepared to pay a higher price. So they're quite a good insight into supply-demand imbalance and the price action of the market you're trading. So different gap types. Basically, I think we can categorize them into four. Now, I think we can go even deeper than that, and I'll explain that in a moment. But for this video, I want to stick to four, and then maybe you can think, okay, I quite like this. I'll go a little bit deeper and see the different permutations of number two, or number three, or number four, whatever it may be. Okay, so let's start with number one first. So number one, by the way, imagine this is a daily chart, and we've got a candle in, we've got the high and the low, we've got the open down here and the close, that's why it's a green candle. That could be either way, but then that creates the subtleties of the gap potentially and the strength of the gap. So we have a scenario where really we can either do one of two things. We can either gap outside of the range, or we can gap inside of the range. Now, almost every trading day is going to have a gap. Right, it's very unlikely that especially if we're taking, let's say, SPY, for example, the S&P 500 in regular trading hour session, how likely is that going to open exactly at the closing print? Not. So we're going to have some kind of gap. Now, if we gap in the range, in other words, if the opening price is between the high and the low, so this would be one of these, for example, right? This would be an in-range gap. So you've got the high put in here, the low put in there. If you're opening up here, you're opening up in the range, okay? It's actually technically a gap down because there's our open here, there's our close. So it's that little difference there. That's a gap lower. So that'd be a gap down, but actually it's still in the range. So we've got in range gaps. We're using the high and the low as the range, and we've got out of range gaps. An out of range gap would be something like this or like this, where the open is outside above the high or below the low. So we've got this fresh air territory in between, okay, like this one here, just about. We've got some fresh air territory where that's gapped lower. Now, we've got outside of range gaps, inside of range gaps. Obviously, when you look at the outside of range gaps, that's much more of an extreme move, okay? If people are enough agreement, the price is even higher, not only than the close, but the prior high. And obviously, you might close at the highs, and we tend to get these kind of runaway markets where this is closed right at highs, and then we gap up. And that's generally what we see when we see that strong persistency of trend. It's a gap up, it happens to be a range gap. But think of different scenarios. You've got this scenario where, okay, if that was a green candle and it closed at or near highs, and then we've got a gap up that gapped out of the range, that's just showing that, hey, there's a consistent demand coming in for this asset, and we can adjust accordingly. We can look at the daily chart and go, hey, do we expect another day's run? Do we expect it maybe to kind of fill the gap before we get long? We can kind of structure the day around maybe a more demand-based approach. Now, if we had the other way around, which was, let's say we did gap up above the high, but this candle happened to be red, so it closed here, and we had this huge gap, all of a sudden, that's way more significant, right? So even though technically it's exactly the same gap, the gap percentage is the same in terms of where it was from the high, but from the close, it's a huge gap, and it's managed to gap right above the range, so it's undone all of yesterday's work. There's so many more people trapped. That maybe would have you positioning for a more urgency drive off the open type trade. You see the subtle distinction. So you've got to kind of look at where's the gap, what was the price doing before, and where's the gap in relation to the prior day's range. So it's the gap out of range scenario. Gap up out of prior day's range is 1. Let's go to 3 actually here. 3 is the gap down outside the prior day's range. That's just a flip of that when that was colored green. So it's closing at or near lows. Doesn't necessarily have to do that. You can have a big tail there, of course, and then you take into consideration how the close was relative to the range to prior day and say, okay, we managed to pull back a little bit, but yeah, we still gap lower. So even though that late fight in the day kind of helped bulls push it up and we didn't quite get the close on lows, we got a little wick in, a little tail in, should I say, but we still gap lower. So it's kind of showing actually the supply is still there. So we've got this kind of gap lower. And again, just like we're looking at with this scenario here, you would look at it in the bigger picture and say, right, is this a continuation gap or is this an exhaustion gap? So trading strategies for that would be, do I believe, and by the way, there's slight subtleties often between the buy side and the sell side. And it's not just the case often as flipping your strategies round and reversing them. You know, you've got more urgency tends to have on the short side, especially when you're trading an index or a stock, when the general propensity is to be long as opposed to a forex pair, which is a relationship or ratio of the two currencies. So in that scenario, you're like, okay, do I want to get short early on, or do I want to see if we kind of get a pop and then sell into that pop, or do I want to kind of see and think maybe there's an exhaustion gap? Because we've talked about different textbook types of gap, and exhaustion gap is where you get that final flush, and very often that's going to be outside of the range, and then it'll fill that gap straight away and start to rip higher. Okay, so number 2 and number 3 are gap up in, oh, so this is a gap down actually. This is sometimes the trap you can fall into, is literally look at it straight away going, that's reasonably bullish. And yes, it is, but that's gap lower. So the overnight session is, we've closed there and we've opened here. So overnight there's been a kind of not necessarily a consensus that this is that strong. And we've had a little bit of a gap lower. And here we've had a gap higher. And in this case, it's kind of come down and it's filled the gaps. These are classic gap fill type scenarios. So gap up within range, gap down within range, gap down out of range, gap up out of range. So now you've got 4 kind of broad categories of gap. And now you can say, okay, well, what's the response to the gap? Is it going to gap up and then just rip? Is it going to gap up and then fill the gap? Or are we going to just completely reverse and then rip? So you start to create some ideas in your mind. And this is where you go back on your daily chart and you go, okay, what's the few candles before that? Any key levels? Is there a significant level now of support that we've kind of gapped under, which is creating a little bit of concern for the buyers? You know, you start to structure it and you start to say, okay, what was the day before trade like? Was it a trend day closing at highs? Then a gap up outside the range isn't that unusual. If it was a kind of a trend day, but then we closed in the midpoint and we kind of put this wide range doji day in and then we gapped up, then, you know, what does that mean? So you start to look at the candlestick subtleties and the shape of the candlestick, the position of the open, the position of the close, the range of it, and then after you've done that and sort of made a judgment of the prior day's strength or weakness based on the candle shape, pretty simple to do, the next day the position of the gap, you go, does that reinforce that trade idea, or does that trap anybody, or does that set up some other thing? Because one thing I'll always look at is, hey, who's trapped? Is anyone specifically trapped here? Have we done a big V-shaped reversal and gapped off highs, and all those people who shorted in the hole are now stuck? Or have we had a really strong trend day? In actual fact, we've kind of, like this, for example, we had a really strong bear trend day, everyone's out the market, everyone's getting short, closing at lows, people expecting it to carry continuation, and then does it gap up? And if it gaps up right above the prior high, which is super unusual, by the way, but if we get that type of thing, get the island reversal, we think we call it, that is super strong, and we go, right, actually, that's really strong, and there's going to be a lot of people panicking. Maybe we'll want to get on board that. So your different gap types, your outside range, your inside range, and then drilling down into those quite deeply, really, to say, hey, what was the previous bar, and then what's the gap, and then you kind of can create your roadmap for the day based on that. I think very often we fall into the trap of just generalizing the gap. Oh, it's a gap up, because that's how it's reported. You know, we're looking at our trading platform, we just see a red number on the open and go, oh, it's gap down X amount, it's gap, and we don't really sometimes look at the relationship between that and the prior couple of days trade. So different gap types, guys. Hope this helps. The next one, keep your risk managed. Bye bye.